roster?
Yeah.
Okay, we're ready. Good afternoon. We're Gonzaga University. This is Tyler and Kayla. This is Michael, Ian, and Duncan. And today we are presenting our investment analysis on Red Lion Hotels Corporation. Red Lion is in a major transition, and due to our analysis, we believe they will be successful at executing their business strategy. That is why today we are issuing a buy recommendation of $13.09 for Red Lion Hotels Corporation.
Red Lion is a hospitality-minded company whose primary focus is providing quality accommodations across all their brands. Currently, they have 13 brands in their economy, mid-scale, and upscale hotel segments, 9 of which are franchised. Overall, they have 1,300 franchise locations, shown here as a heat map. In 2016, they acquired Vantage Hospitality Group. This brought in around 1,100 new franchise locations and additional brands, and brought the company from being regionally focused to having international exposure. In 2017, they divested from their interest in the entertainment industry by selling off their Tickets West and West Coast Entertainment. This represented a drastic simplification of their overall business model. Now, barring the performance of the stock market in the last couple of days, we see that in the last 1 month, the last 3 months, the last 6 months, and the last year, Red Lion has consistently been able to outperform the market as a whole, shown here compared to the Russell 2000. Now, given our analysis of the company and their performance, as well as being validated by recent upticks in the stock price, we are issuing today a buy recommendation of $13.09. This represents a 29% increase for investors. This was garnered through our analysis of multiples models and a DCF cash flow model.
Red Lion's long-term strategy is to transition from a capital-intensive owner-operated company to an asset-light franchisor. They're going to be doing this in 3 different steps. Firstly, they're selling 11 owner-operated hotels, mostly located on the West Coast, with 5 already in the closing stages of agreement. Secondly, they're going to be revamping their brand by slimming down brand availability from 13 to 9 distinct brands. In addition, they'll be targeting millennials through their brand availability and marketing techniques. Lastly, they're going to be aggressively expanding their franchising segment. And we've seen this. We've estimated in 2017, Red Lion has signed an estimated 150 franchise agreements. Through the program Franchise Easy, existing franchisees are designed to become Red Lion franchisees in as little as overnight. Now, given our recommendation and our analysis of the macroeconomic conditions, the industry conditions, and the demographics of the United States, we believe that Red Lion will be successful in implementing their long-term strategy. Over the macroeconomic sector, we've seen increasing growth in GDP and consumer spending, which will be positive for Red Lion's long-term strategy. In addition, the hotel industry has also experienced major changes, with revenue per available room, or RevPAR, a major hotel industry metric, increasing over the past 5 years. Lastly, demographics are also going to play a key role in the strategy, as I said earlier. Over 45% of the population is within the millennial bracket of 18 to 34 years, which will provide a great analysis for Red Lion's future targeting of millennials in the future.
The federal disclosure documents, or FDD filings, are federally mandated filings for any brand that has franchise agreements. It outlines the contract obligations between a franchisee and a franchisor. So given the required nature of this, we were able to analyze Red Lion and compare them to the 50 largest brands inside of the US. So given our analysis, we were able to find that Red Lion has both the lowest application fee and the lowest first-time royalty payment fee for their franchises. This represents an incentive to bring in franchisees and investors due to the potential for higher returns on investment. Additional incentives include a flat royalty fee and a flat program fee. These are the largest costs for franchisees to their franchisor, and because of the flat fee nature, it's going to attract certain types of franchisees, as well as because of the flat fee nature, give definitive revenue numbers regardless of overall economic performance to Red Lion. Additional incentives include things such as low-cost conversions and low-cost constructions for disenfranchised franchisees from other companies, which will help grow their segment faster, and other flat fees. These are incentives that only Red Lion is able to offer in the market as a whole.
Red Lion will be successful in executing their strategy due to their corporate governance practices. This begins with their experienced executive team that has already led success in the growth of Red Lion. CEO Greg Mont has 25 years of experience within the industry. Additionally, CFO Douglas Ledwig holds 13 years of past experience as a CFO of 4 Seasons. We believe he'll be able to replicate this in his model of changing from an asset-heavy to an asset-light business model. Secondly, Redline's performance incentives are strategically weighted towards having success of their business model currently. This is weighted 30% towards new signed franchise agreements and 70% towards EBITDA growth targets. Finally, the company has a 29% insider holdings, which indicates a strong alignment between shareholder and management goals.
Our faith in Redline's executive and corporate governance structures is further affirmed by the M-score analysis that we ran. The M-score, a highly regarded probabilistic model of earnings quality, provides a score for any given company based on their financial changes year over year. Anything below a negative 2.22 threshold indicates companies with high earnings quality. Companies that score above this threshold could have concerning financial situations in the future. As you can see here, Redline has managed to fall below this score from 2011 to 2015. Only in 2016 was Redline's score above the negative 2.2 threshold. This was caused because of the advantage of acquisition, which brought in a large number of intangibles. Thus, we believe that Redline's financials are secure, and this gives our models further credibility as we move forward. In creating revenue forecasts for Redline and for forecasting future profitability of Redline, we considered that the franchise agreements executed would be at least 130 each year, and that the revenue from owner-operated hotel rooms would decline as they sell 54% of their hotels in the next year alone. This will translate into the numbers, as revenue will change from 75% managed and owner-operated hotel revenue to 94% franchise revenue by 2022 alone, changing EBITDA margins from 10 to 18% over the next 5 years. This will increase Redline's profitability, and we've seen that the option to invest in Redline is still there, as they are undervalued compared to their peers in all but one metric, EV to EBITDA. This represents significant upside for investors, and this is shown in our DCF model as well. In the DCF, we used a levered and unlevered DCF model with cost of equity inputs of 10.29 and a long-term growth rate of 2.67%. Overall, this provides us with our target price, with our prices of 1086 and 1582, and a combined target price of 1308.
Despite our optimism with Redline, we do have a few concerns. First is the seasonal fluctuation in prices that affects the entire hotel industry, that show distinct peaks in sales in the summer months and dips in the winter months. This is well known throughout the industry, but it could create a cash flow problem for Redline in the future. Second is the volatility of consumer discretionary spending. Whenever there is a market correction or a dip in disposable income, the American budget first cuts out leisure spending in the hotel industry. Redline specific risks include the launching of new programs such as RevPAC and Hotel Aura. These are new programs that Redline has invested heavily in to their company, and a failure could be drastic. There's also the inherent real estate risk that Redline is undertaking by selling 11 of the remaining owner-operated hotels. A market downturn could hinder their ability to fetch their $160 to $170 million asking price. Redline's small firm size could compound these risks, but we believe it'll work to their advantage. As a small firm, they can maneuver throughout the market better than a large firm could. They can react to market conditions better as well. This, however, could make them a potential acquisition target. They will be cash rich after selling off their 11 remaining owner-operated hotels, and they are following the titans of the industry by going asset light as the business model. Despite these risks, we still retain our belief that Redline will hit a one-year target price of $13.09. They have an experienced and enthusiastic executive team. Their franchisee incentives will help win over disenfranchised franchisees. Through our metrics, we've shown you that they are a value pick, and we believe that right now the market conditions are right to buy Redline. Very much.
At this time, we would like to entertain any questions you may have for us.
Well done, thank you. Just a little bit on the CEO who's been in place since I believe you said 2014. Can you give us a little bit of background on him, and does he have a track record of success with respect to turnarounds of this nature?
Yes, he definitely does. So he's had a lot of past experience in the operations and the management of similar franchise growth models. This is shown, I believe, in his, he's been involved in a few other companies. And then through this, his entry into Redline, I believe, is a great opportunity for him to execute a similar model.
Was he with a major branded hotel chain prior to Red Lion?
Yes, he was, but I am blanking on the name right now. I'm so
Yeah.
sorry.
It was Four Seasons.
Oh, he was
No.
also with
Are you
Oh,
talking
sorry.
about? You're talking about.
the CEO. Yeah, the
No,
CFO.
CEO. Sorry.
Yeah.
Do we have the board? Do we have
Oh, yes.
We have. Right.
Or would that be?
No.
No.
That's all right. We can just get on to
Sorry,
the next
no.
question. That's fine.
I'm so sorry.
And the use of proceeds from they've sold 5 of the 11 slated to be liquidated. Use of those proceeds. What are your expectations?
Largely, we expect them to use those proceeds for debt. Beyond that, I would expect capital expenditures of existing hotels, which is kind of cash flow model. And beyond that, probably maintaining desired capital level.
Right, and their capex level would drop pretty significantly, I'm assuming.
With the sale of their managed hotels, yes, we would anticipate that. Naturally, there will be investment in other areas of the company, as those are asset light. So it's not going to represent a significant outlay for Red Lion.
Right, and you mentioned 29% insider ownership. Any breakout of that, CEO, CFO?
Sorry, could you repeat the question?
Oh, just insider ownership, management ownership of the stock.
They're 29%.
29%,
Insider
yeah.
ownership. What is it?
Yeah, I'm just wondering, how any thoughts about how that's split? The CEO own, 8-9%. Any percentage breakdowns by management there?
Well, as we've seen in the 2017 of May, they introduced this new performance stock incentive program, which we think has really increased their ownership of insider holdings. And we're really excited about this because it's directly tied to their strategy of growing their franchise agreements, which we think is the key goal for Red Lion today, is to boost the incentives for their franchisees.
Go ahead, Craig.
In your discounted cash flow model, you said your long-term growth rate is 2.67%.
Yes.
Can you explain what you're growing at 2.67%? Is that top line? Is it EBITDA? Is it bottom line? And at what benchmarks, beginning point?
This was the long-term growth rate for the terminal value, I believe. I believe it's well from the discount.
So that's after the 5 periods that we projected. The terminal value will grow at a rate of 2.67%, in line with our conditions that we set forth on the economy, on the industry, and on demographics.
So the question is, what is growing at 2.67% after the 5-year period?
The future cash flows.
It's the answer. Oh, free cash flow?
Yes.
Free cash flow.
Yes.
Okay. All right. Somebody went through this required filing the FDD.
Yes, I did.
Does that refer to a retention rate of franchisees?
No, the retention rate is something completely different. It's what you probably would be referring to, and correct me if I'm wrong, is how when there are newly acquired Vantage Hospitality Group franchises, they brought in the 1,100 franchise hotels, and then as those contracts are expiring, they have the ability to renew them or not. They are choosing to renew most of them. Some of them they aren't because they're underperforming locations. But any sort of offset that's been seen by losing these franchise locations, we think is going to have a net growth in the future with new franchise agreements. We have seen in the last, I believe, 2 quarters that there has been a net decrease in franchise locations overall. But we don't see this to continue in the future.
Why not?
Because of their incentives that they have here. It's basically newly instituted as of this year with their new brand acquisitions from 2016. And because of the new brands they were bringing in, such as Hotel RL, they're giving these specific stock incentives for franchisees from other companies who are disenfranchised from them to come into Red Lion, go to a Red Lion brand, and then also have the benefits of what the franchise agreements would hold.
Good presentation, you guys. So I noticed as of the last quarter that their own hotels division had an operating margin of 18.6% versus their franchise business only has operating margins of 15.6%. So why would they be selling their high margin business and reallocating those resources to the lower margin franchise business?
Volume and risk. you have 11 owner-operated hotels, there's a chance of a market downturn in a specific area. But if you have 1,000 franchise agreements spread across a wide region across the nation, you have more exposure, more diversification in holdings. And Douglas Ludwig spoke about this to us, that the asset-heavy model isn't necessarily bad in itself, but it's bad in that it could create unnecessary risk and increased capital costs or capital expenditures for Redline.
So if under the franchise model, then it is a flat fee structure, right, where each franchisee is paying the parent X dollars. In a downturn, would you be concerned that those franchise partners would get squeezed? And how would the parent Redline Hotel handle that in any type of an economic slowdown?
So it's a little small for you to be able to see on this screen. Not every franchise is flat fee. The majority of them are. Only 2 of their franchises, America's Best Value and Country Earth, have variable rates. Yes, it is true that in the future going forward that they can be squeezed. But one thing that we also see is that while other companies, their largest expenditure is about 9% of overall revenue coming into the location goes to their host company, with Redline, because of the flat fee nature, even in good times and bad times, this flat fee structure keeps that price still below that 9%. So overall in the industry, they'll perform better than we'll see other brands compare.
Do they have any history of doing deferrals with their franchise partners? So if the franchise partners had bad weather or an economic slowdown where they can defer those fees, get them through the couple of quarter downturn, how do they handle that?
I can't speak to specific examples, but Douglas Ludwig has specifically said that they're working with different franchisees to make agreements with the franchisees when they come in. So the contracts are amendable. So they would possibly be able to put a line item in for a situation such as that. The other thing is that when they deal with locations such as in Houston with past hurricane season, they're able to go to the franchisees and say that given this situation, we understand what happened, we'll be able to work with you, let's get an agreement and see what we can do to help you get back on your feet.
Great response. Rich, do you have a follow-up?
Yeah, could you touch a little bit on trends in RevPAR, what you've seen with this management team as they've come to enact some of their policies? What have been the trends in specific to Red Lion?
A great question. Overall, the past 5 years, RevPAR for Redline has only gone up maybe 1 or 2%, not been a huge change. But again, you're speaking to the fact that they are in really their 3rd year of transformation. So like I said, this long-term strategy really hasn't seen enough fruition yet to really get to the point of what you're talking about with RevPAR. So I think it's still a little too early to tell on how that long-term strategy will affect RevPAR historically, but we believe that it will affect RevPAR.
Right.
To add to that a little bit, because of the increasing portion of the hotel that's going to be going into luxury brands, it probably will increase it, but chances are that it'll stay proportional to where the company is at right now.
Okay, I'm good.
How important is the M-score in your analysis?
M-score was an analysis that we ran just as a diligence process. Really, the M-score provides a measure to understand whether or not the company is potentially financially unstable or potentially not doing well. Companies that have scored higher than that negative 2.2 threshold have a higher history of bankruptcy, scandal, things like that. So with the M-score, what we did is used it as a way to kind of be sure of our financials, of the financial statements they were describing. As Red Lion is a fairly complex company with the joint ventures that they've entered into, it's something we wanted to make sure of.
Okay, thank you guys.
Thank you.
Thank you. Would you like us to do anything with this, or just-
Oh, you can just leave it there.
Okay.
Yeah, thanks guys.
Thank you.